Okay. So any questions from yesterday? Okay. The other thing is I do have the assignment, and we will, let's do one thing. Let's wait for a little while. Let's start. If around the break we will hopefully others would have joined. We will then I'll then share the assignment with you so that and then any questions on that we can then discuss at that point because everybody else will be there. Otherwise, there'll be people who will miss out. Okay. So, okay, let's start. If there's no questions from yesterday, let me start with the next thing, which is how do you determine these futures and forward prices? We talked about, and this is particularly relevant because there are different kinds of assets and asset categories that kind of come in. So one needs to kind of look at that in that context. So basically, we are going to look at assets, and there are these different kinds of assets that we are going to look at. We can have investments, investment assets which do not have any income during the contract period. So remember, these are all little contract periods, 1 month, 3 months, 6 months, whatever. So during that period, there is no income. We are not talking about whether it has income or not outside the contract period, but during that period, there is no income. That's one possibility, one kind of a possibility. The other possibility is that there is an investment, the investment asset which has known income. So we know how much income will come in during that period. So we actually know what the income is going to be during the contract period. The third kind of an asset is a stock index. So it's like the index, not the stock itself. So it's like your Hanoi stock index value and not the value of not let's say the stock of a bank or Vietnam Airlines example that I all have, because those come under the first two. This is the index. Then you have currency, which is whatever the currency they talk about. Obviously, for most of you based in Vietnam, it will be the VND. So what is the currency argument? And then you have commodities like gold, silver. So there are two kinds of commodities that you can have. You can have investment commodities like gold, silver, precious metals, and stuff like that. Or you can have consumption commodities, which will be used. So a lot of your agricultural commodities and things like that. These are what are referred to as consumption commodities. Now there is an overlap, and before anybody asks, I will explain that as well out here. So there is this investment assets, and there is this obvious argument of consumption assets. The broad definition of an investment asset is that these are assets that are held primarily by people, for most number of significantly large numbers of people, purely for investment purposes. Financial assets, gold, silver. Now let me just complete, and then if there's still a confusion, I'll go back. On the other hand, consumption assets are those which are held primarily for consumption. So like all your agricultural assets. So if you are holding food, agricultural product, rice, you can't really store rice for investment. You're buying rice and you're holding rice because you want to consume it. You need it at a future point in time, and therefore you're buying it for consumption purposes. So copper, oil, these are examples of consumption assets. However, now there is a gray area. There is an overlap. There is a gray area. And what is the gray area? The gray area is that silver, gold, some of these and some other investment assets are also used by the industry, are also used for production. Because for example, gold and silver is used. Silver is in a lot of cases used in the electronics industry. A lot of precious metals are used in the electronics industry. So therefore, you could argue that these have also been consumed. Yes, they have been consumed, and to that extent, they are consumption assets. But on the whole, more people hold these assets for investment purposes and not for consumption purposes. So even though they can be used for consumption purposes, since majority of the people hold it for investment purposes, we treat this as investment purpose, as an investment asset, and not as a consumption asset. Now, why are we segregating, or why are we separating this in this manner? The reason we are separating this in this manner is because the whole argument of usage of arbitrage. If it is an investment asset, the arbitrage arguments can be used to determine the forward or the future prices of an investment asset. However, when it comes to a consumption asset, you cannot do that. Arbitrage assumptions will not perfectly work in the context of consumption assets. Now, what are some of the assumptions that go into pricing, whether it's a forward or a futures contract? Well, we assume that there are no transaction costs when trades happen. Market participants are subject to the same tax on all net trading profits. So everybody is exposed to the same tax rate, right? Or you can also ignore taxes. I mean, that doesn't matter. Because it's an assumption and tax will be applicable uniformly. So whatever is the payoff, we will simply apply the tax rate and pay the tax further. The third bullet point is actually a bigger assumption and a more complicated assumption. What you are saying is that your people can borrow and lend exactly at the same rate. Now, this is kind of very, very artificial and very, very academic, because in practice, you will not have, when you go to borrow money at the bank and when you deposit money at the bank, that's when you're lending money. The rate at which you put money in the bank is obviously less than the rate at which you will borrow. This is the normal scenario. However, in an ideal perfect market, there shall be no difference, and that is what we are assuming, that the borrowing and the lending rates are the same. Therefore, the participants can borrow money at the same rate as that they can lend. And again, for want of a better choice, we kind of say that all of that happens at the risk-free rate of interest. Further, if there is an arbitrage opportunity, market participants will take advantage of it as and when they occur. So it is not, because remember, arbitrage will give rise to riskless profits. So if there is an arbitrage opportunity and I have spotted it, I will make use of that. I will access that and use that, and I will take advantage of that, because that is a profit that that is a profit that I make. Finally, under equilibrium, there will be no arbitrage pricing. And that is not violating the previous assumption, because what we are saying in the previous assumption is that if arbitrage exists, you will take it. Now, arbitrage exists only because the markets are imperfect or they are not at perfect equilibrium and things like that. In a perfect market with full disclosure of information, with full information available, there will be no possibility of arbitrage, and that is exactly what we are saying out here, that under equilibrium, when the markets are perfect, there will be no arbitrage that can happen. So how do you price it? Notionally, this is let's say the current price is S0. F0 is the futures or the forward price at maturing on date T, and then but you know the future price today. So in other words, you know how much the price will be on that day. Obviously, we'll have to write down F0. We want to find out F0, and that is what we want to do. T is the time until the delivery date, and R is the risk-free interest rate, zero coupon risk-free, the interest rate in the market with continuous compounding. So we assume it to be continuously compounded, which means what? That when we calculate the present value, we will discount it at e to the power of minus RT. We will multiply it by e to the power of minus RT instead of multiplying it by 1 plus R raised to the power of T. So that is the difference that will show up in this process. So now if you take an investment asset, if the forward price is greater than the expected future expected future spot price, S0 into the power of RT, then essentially there is an arbitrage possibility, because one could buy the asset, short the forward contract on the asset, realize that on the day of maturity these two will match. So I have the asset to so basically I can deliver the asset which I have, but now I have managed to sell the asset at a price higher than the forward price of this asset as the asset price has moved up, and therefore I made a profit. That is my, and I've done the deal upfront. So therefore, I have an arbitrage profit that I have got. If the price is the other way around, if the forward price is less than the expected future spot price, I will do the reverse. I will short the asset. I will go long in the contract because I will be able to. I've sold the asset. I have more money. I have bought the futures contract, which means on that day I will actually be able to buy the asset back at a cheaper price and still have cash left with me. So therefore, so in both the scenarios, there will be arbitrage possibilities that will kind of come in. Now, obviously, we said that there cannot be an arbitrage opportunity, which means that this has to be equal. So therefore, F naught will have to be equal. The forward price will have to be equal to the expected future spot value, and that because that is the only scenario where there will be no arbitrage. For all other scenarios, there will be arbitrage. So this equation, and this is relevant and correct if the forward price and that it links up the forward and the spot price for any investment assets which provides no income during the lifetime of the contract and has no storage cost. So I'm not adding any additional storage cost and stuff like that. Obviously, there could be storage costs and things that will actually have to be addressed, in the next slide as well. So if you look at this as an example, let's say the current asset price is 400. The continuously compounded interest rate is 5%. The maturity of the contract is 3 months. So S naught into the power of RT, R naught T. Okay. Now let's do two scenarios. I'm taking two scenarios. In one case, the forward price is 430. In the other case, the forward price is 390. If the forward price is 430, you see what I can do. I've solved it out there. I can borrow 400 at the given rate of interest for 3 months. Using that, using the borrowing, I can buy 1 unit of asset, enter into a forward contract to sell this asset in 3 months at 430. Now, after 3 months, remember, I have to repay the 400. 400 at 3 months will get me 405 to repay the loan with the interest. But by selling the asset, I will earn 430. So therefore, I have a realized profit of 25. And if the other case happens, well, I will borrow the asset and sell it in the market, earn 400 in the spot market, invest this 400 at the given interest rate for 3 months. Therefore, and enter into a spot contract, enter into a forward contract to buy the asset in 3 months' time for 390. At the end of 3 months, what will happen? The 400 that I have invested has now become 405. I use 405. I use 390 of the 405 to buy the asset. So I'm left with the asset and 15 in cash. So therefore, again, I'm making an arbitrage profit. Again, I'm making a profit. So obviously, if this happens, there will be arbitrage profits that will happen. The good thing is that these positions cannot continue to infinity, because the moment an arbitrage profit happens, others who have probably not spotted it as yet right, and therefore there will be a correction that will happen. So what happens is the first guy who makes the money has the profit, but subsequently the market readjusts, and you kind of get to the point where again the prices has readjusted, and therefore there is no additional profit to be made in the process. Right? Now, the only thing that I would want to kind of highlight out here, which is important, is you see, now while these strategies are correct, depends on where you start, you will have an arbitrage profit. For example, in the first period, if you already have an asset, so if I look at case one was under the assumption that I did not have an asset, I could borrow and buy the asset and do whatever the rest of the structure is. Now, if I already had the asset, using that asset, I will not be able to generate an arbitrage profit. It is basically on the assumption that I do not have the asset, and I therefore can use this strategy to make a profit. Similarly, on the other side for case 2, if I assume that I did not have the asset, if I assume that I have the asset, sorry, here I'm borrowing the asset, I'm selling the asset. Yeah, if I assume that I can borrow the asset and short it, but essentially if I had the asset, so I mean in a sense I would have to start by arguing that there is some way I will have access to the asset which I can short. If I did not, then again this strategy will not work and this will not give me anything. Okay, this is the case when you actually say that, okay, the other side, when you say that, okay, the investment asset provides a known income. The stock paying the known dividends and coupon bearer. So these are stock, this what kind of assets are these? These are stocks which pay dividends and we know how much a dividend is going to be paid, or bonds which pay coupons. What do? I then say, okay, let me take I to be the present value of all the income that will come to this asset during the life of the contract. So I is nothing but the present value of all the income that will accrue during the life of the contract. And then what I can do is that I can recalculate the forward price by looking at, because essentially what I'm saying is that you actually have the known income, calculate the present value. So I is the present value of all the income that is going to happen in that period. So what do? Basically, the point is, let's say I have a forward contract to buy a stock after 1 year. In between, there is a dividend. Who will get the dividend? Will I get the dividend, or the person who's owning the stock today get the dividend? So let's say so specifically, I will buy a stock. I have a forward contract under which I will buy the stock from you 1 year from today. In between, so you own the stock today, I will buy the stock from you after a year. In between, when there is a dividend that is paid, who will get the dividend? Will I get the dividend? Will you get the dividend? Who will get the dividend? Who do you think will get the dividend? The holder of the stock, or the person who will buy the stock after at the end of the forward contract? Who sells the stock? Exactly. You're right. Who's owning the stock today? Who sells the stock? Now, therefore, the person who buys the stock will never have access to this dividend, but the current price of the stock includes the impact of this dividend, and that is why the stock, for the person who buys the stock, I have to reprice it, taking out the impact of this dividend. So what do? Therefore, I say, okay, I will calculate the present value of the dividend, subtract it from the current stock, and then forward value it to calculate the forward price, so that no arbitrage opportunity exists. So in the now, if I know the exact income, I can write it as S naught minus I, where I is the present value of all the future cash flows during the life of the contract, and forward valued it at the interest rate R. On the other hand, instead of giving you the exact value, if I give you the rate at which that income will come, so essentially, if I say it's an average yield during the life, which is Q, then the formula will simply become S naught e to the, instead of being S naught e to the power of RT, it will be S naught e to the power of R minus Q times T. Okay. So that is how this will kind of come about. Now, a stock index can also be viewed as an investment asset paying a dividend yield, because individual stocks pay dividends, but the stock index is a combination of all of that. So I can kind of take it as a dividend yield. And it is typically assumed that dividends will provide a known yield rather than a known income. So they'll tell you how much return they'll give you as opposed to an absolute amount. So the futures and the spot price relationship therefore becomes e to the power f naught, sorry, s naught e to the power of r minus q times t, where r is the risk-free rate, q is the average dividend yield on the portfolio represented by the index during the life of the contract. When will arbitrage happen? This will happen when f naught becomes greater than s naught e to the power of r minus q times t. The arbitrager buys the stocks underlying the index and sells the future. When the reverse happens, he buys the futures and shorts or sells the stock underlying the futures. And therefore, that will lead to an arbitrage profit for him going forward. Similarly, for a foreign currency is very similar as identical to a security providing dividend yield. Because while the domestic currency moves at pays an interest or is adjusted to a domestic interest rate, the foreign currency will move at a foreign interest rate. It's like this: you go and make a deposit of whatever amount of money in a bank in Vietnam. How much money will you get? You will get the interest rate in Vietnamese dong. So you will get, if the interest rate in Vietnam is, let's say, 7%, you will get 7% on your return on your investment. On the other hand, if somebody were to invest in US dollars in the bank, keep US dollars in the bank, they will also get a return, because after all, the investment return from there should also come in. Okay. So therefore, I can treat this as a security analogous to paying continuously, providing a dividend yield. And the deal is that what we take is that the continuous dividend yield is the foreign risk-free interest rate. And once we know the foreign risk-free interest rate, it follows that RF is a foreign risk-free interest rate. Put it in that equation, so it will become R minus RF times T, and it's not, and then that will kind of give you the. So that will take care of the problem. So now if I look at investment commodities, remember I had investment commodities. So for example, look at gold, silver, gold lease rate. Gold among the largest owners of gold are the central banks. The gold owners like central banks will charge interest in this form when the gold lease rate when they lend out gold. So somebody needs money, if somebody needs gold, so let's assume, but now if you have gold or anything like this, you will need to store them, and storage does not come free. So there is a storage cost that you have to pay. So let me assume that U is the storage cost per unit of time as a percentage of the asset value. So then this is a cost that you have to pay to invest and to hold the gold. So this is kind of treated as a negative income or a negative yield for you. And then F naught becomes equal to S naught into the power of R plus U times T. The cost essentially goes up. Unlike in the previous case, when I was in the earlier cases, realized that I was looking at R minus Q, here it becomes R plus U. And alternately, if you know the if you know the exact value of the storage, not the rate but the exact value, then you can write down the price itself can be changed and adjusted to look at S naught plus U to the power of RT. So it depends on whether you know the exact value or you know the rate. You can either have it as U or you can have it as either as a combination of e to the power of R plus U or directly as S naught plus U, and you have the same argument coming in. Oh God, the same problem has happened here again. However, if it is a consumption commodity, this provides no income, but consumption commodities usually provide no regular income, but can be subject to significant storage costs, because you realize that you can actually have costs which can be significantly high. For example, if you need to store coffee, you need to store rice. there is a cost of storage that will come in. An arbitrage strategy cannot be used in these cases because many times inventory in individuals or companies are reluctant to sell their inventory, to sell the commodity that they store in inventory because they will need it for their own purposes. So they will really not sell it down and they will keep it as inventory. So the consumption commodity for the consumption commodity, the correspondingly valid equations are the equation is correct. It will be F naught is less than or equal to the term on the right hand side. So the what is not showing up out there is the less than or equal to sign. It should be less than or equal to the so F naught will be less than or equal to S naught plus U times e to the power of RT or S naught into e to the power of R plus U times T. So it will be so the thing that you need to be careful about there is the F naught be less than the right hand side, whereas in the context of investment commodities, to avoid arbitrage, it will actually have to be equal to that. Now there is also something called convenience yield, and that happens because because of owning this asset, the producer. So, for example, think of it: if you are a power producing an electricity generating plant, and if you generate electricity using coal, thermal power, then you will actually want to hold coal so that whenever needed, you can use the coal for thermal production and generate electricity. And therefore and particularly in power and all, it becomes relevant because the cost of shutting down a power plant is very high. So therefore, you might want to hold the coal to prevent to prevent any short-term shortages or that can happen. So the benefit of holding the physical asset is what is referred to as the convenience yield. And the convenience yield is provided by a commodity. So the benefit of holding on is what is called. Benefit of holding this is what is referred to as the convenience yield. So if the dollar amount of the storage cost is known, so if you know the actual dollar value, then the present and it has a present value U in that period, then the convenience yield is Y, then that equation has to hold F naught into e to the power of YT should be equal to S naught plus U into e to the power of RT. And if they are written down as a proportion of as a constant proportion U of the spot price, then essentially it will be the left hand side remains the same. The right hand side becomes S naught into e to the power of R plus U times T. And therefore, if you bring all of this together, it becomes F naught. F naught becomes nothing but S naught e to the power of R plus U minus Y times T. That becomes the value of the forward price under the convenience yield argument. So one way to look at a convenience yield is to kind of define the convenience yield as the market's expectation concerning the future availability of the underlying commodity. And the obviously greater is the possibility that shortages will happen, the higher will be the convenience yield. On the other hand, if users have high inventories, then there is very little chance of a shortage in the near future, and the convenience yield tends to be low. But it's kind of a catch-22 because on the other hand, low inventories lead to high convenience yields. Now, for investment assets, the convenience yield has to be zero because there is no additional cost of it. Because if it is not, then you will end up having arbitrage opportunities. So the generic framework is what is called as the cost of carry. The cost of carry is the storage cost plus interest cost less any income earned. For an investment asset, these two still have to be equal, and therefore there is really no difference. For a consumption asset, the forward price is less than S naught e to the power of CT. C is the cost of carry. And for a consumption asset with convenience yield, this becomes C minus Y times T to the power of C minus Y times T. S naught e to the power of C minus Y times T. Right? Okay. So now, given this, how do I value a forward contract? and therefore the futures contract also. So what we do is the value of the forward contract. Remember, the forward contract is a bilaterally negotiated deal between you and me. What we do is when we enter into the contract, the value is on that day, the contract is valued in such a manner that the value of the contract is 0. Subsequently, however, the contract may have a positive or a negative value. There's no stopping that. Because what happens is today's value is, how does the value become 0? The value becomes 0 because the price that it is set at is equal to the expected future spot price as of today. And therefore, that makes it equal to 0. This value does not change. But as you go to tomorrow, as you go forward, the expectation of the future value can change. And if the expectation of the future value changes, you will obviously have a non-zero amount. And therefore, it could be both positive or negative. I mean, it could be both positive or negative. Right? Banks and financial institutions will always have to value this contract on every day, because that is what will tell them how much of a profit or loss are they sitting on in terms of the contract, and if they want to exit from the contract or do something in the contract. So how do I value the contract? So let's say K is the delivery price. So the K will be the price at which delivery will happen as entered in the beginning. F0 is the forward price that would apply to the contract today, which is the valuation date. The value of the long forward contract, when you have bought the contract, F is the forward price minus the today's forward price minus the original forward price that was delivery price that was set up, discounted. But remember, both of these will have a payoff at time T. So therefore, the price today is that discounted to today, which is minus KT, minus RT. Similarly, the value of a short forward contract today is K minus F0 e to the power of minus RT. So in the first case, you want to so what happens? The value of the long forward contract is you calculate the payoff on the maturity, discount it to the day on which you are valuing it. Similarly, what is the value of the short forward contract? Exactly the other way around, because there you will be selling at you will be selling at K and you will be buying back at F0. So K minus F0 again discounted back to today is what your value of the short forward contract is. Now you can also have other types of forward contracts where we know F0 is obviously going to be equal. The forward value today has to be equal to the expected future spot rate S0 e to the power of RT. However, you can have forward contracts on investment assets which provide a known income, as we saw earlier, with present value is I, and that is S0 not just S. So it is not S. It is F0 minus K, but it is not actually F0. It is F0. It is minus the present value. So S0 minus I minus K to the power of minus RT, because the payoff is the value is being calculated today. F0 minus K is the value benefit on maturity. So what is the benefit today? F0 into the power of minus RT into minus K. But F0 into the power of minus RT is, if you take the top line, is S0 into the power of RT minus into the power of minus RT. So it's basically S0. So S0 minus I minus K to the power of minus RT. So therefore, the value of the forward contract will simply become S0 minus I minus K to the power of minus RT, or when it is with a known interest yield, the yield rate of Q, it becomes S0 into the power of minus QT minus K to the power of minus RT, where Q is the yield or the income rate at which the income is happening, R is the domestic interest rate or the rate at which you will have to pay if something happens. Now, if K is the expected rate of return by the, so what let's say K is the expected return required by the investors on an asset. So you can invest F0 e to the power of minus RT at the risk rate and enter into a long futures contract, so that the cash flow at maturity ST, so that you have a cash flow at maturity ST. This shows so this will show that the prices, so this will actually be equal. So there's an equation which is obviously not showing out here, but it is there on your slides. This will essentially show that F naught will be nothing but at ST is S naught into the power of R into the S naught is ST minus K. So essentially you can then adjust it for the K function that comes in. So formula is again not shown up out here. Now what this implies is if there is no systematic risk in the market, then Fk is equal to R and F naught becomes an unbiased estimate of the future value St. If there is a positive systematic risk, which means K is greater than R, then F naught is no longer an unbiased estimate. F naught becomes less than the expected value of St. And if there's a negative systematic risk, in other words, K is less than R, then essentially F naught becomes greater than the expected value of St. So that is where the change happens. Now this also happens that if a forward and futures prices, okay, this is something which also you all need to kind of be a little aware of, that the forward and the futures prices are generally assumed to be the same. They should be the same, right? However, when interest rates are uncertain, in theory they are slightly different. Ideally, they should be the same, but given that interest rates are uncertain, the uncertainty in the interest rate does play a role, and therefore these become slightly different. And why does this become slightly different? Because as you can see out there, the strong positive correlation between the interest rate and the asset price would typically imply the typically imply that the futures price is slightly higher than the forward price. And a strong negative correlation would imply exactly the opposite, which is the futures price is slightly lower than the forward price. Further, in practice, you have taxes, you have transaction costs. Remember, in futures, there is a margin. Forward contracts do not have margins. So these cause the price to be different. Also, as the life of the contract increases, as you have a longer and longer contract size, the difference in the prices become that much more significant. Now, specifically, like we've talked about the futures contract, this is the forward contract. It is an OTC contract with an agreement to buy or sell an asset at a future point at a pre-decided price. Now, one of the things which is obviously very important and useful and holds across futures and forwards is the fact that there is no cash, there is no payment which is made at the time the contract is entered into. So when you enter into the contract, there is no cash flow that will happen. It is only an arrangement or an agreement to do a transaction or do a trade, make a payment at a future point in time. And this is true for both futures and forwards. Now, for a forward, unlike a futures, remember we said is an exchange traded contract. A forward is an OTC contract, and therefore, given that it is an OTC contract, it will be created specifically to take care of the needs of the contracting parties, to kind of address the needs of the contracting party. Now, usually, unlike futures, which are generally not physically settled, most futures contracts are cash settled. Forward contracts are usually settled by delivering the underlying. So the usual contract will be physically settled. However, there is obviously a possibility of cash settlement also in some cases, and that is what is referred to as a non-deliverable forwards. Because sometimes, because of regulatory requirements and all of that, you are not in a position to deliver the underlying asset. Currency is a good example of that. You might want to give the currency. You are okay to kind of pay in that currency, but other requirements prevent you. Regulatory requirements prevent you from taking the currency outside the country. VND is one example. You can use VND in Vietnam, but you cannot pay in VND. Let's say when you go to France, so if you are sitting and doing a deal on the currency in Vietnam, sitting in Paris, you cannot say I will, and then there is, let's say you have to pay, whatever, 5 million VND or 10 million VND. You cannot say that I will pay 10 million VND because VND has zero value because of the non-convertible nature. VND has zero value outside Vietnam. So even if I gave 10 million VND in Paris, it actually has zero meaning for him. So that is where it basically, what we'll have to do is we'll have to cash settle. So somebody will have to take it and then, clear off the position by kind of paying it off in cash. That's what an NDF or an non-deliverable forward is. The key difference from a futures contract is, unlike in a futures contract where the exchange guarantees the credit risk and therefore no individual bears the credit risk, in a forward contract, each of the parties bear each other's credit risk. So when you and I enter into a contract, I bear responsibility for your likelihood of default, your credit risk. You bear responsibility of me defaulting, and therefore you bear my credit risk. So each party bears two parties to the contract bear each other's credit risk. How is the price chosen? As I said earlier, the price is so chosen that the initial value of the contract becomes zero. Also, as I was just repeating, at the start, no money changes hands, so nobody pays anybody anything. Just an arrangement that I will pay this against the asset or against this on so and so date, and this is the amount that I pay. So this is essentially a contract that is negotiated, and the contract is only settled at maturity. Typically, it's going to be physically settled, but most cases. But it can have, as I showed you, as I gave you the example of an NDF, you can have a cash settlement also, and it can be done to do other things also for credit enhancement and then compensating balance, letter of credit, and all that can happen. Generally, standard documentation is also applied in the whole thing. Now, as I said earlier, the forward contract starts out as a zero value contract. That is, neither party pays the other anything upfront. However, as you go forward, this contract develops a plus or a minus value as the market rates move. So it could kind of have a positive or a negative value as the market rates have moved. So a seasoned contract would generally have a non-zero so therefore, as you go forward, the contract could have both positive or negative values. The extreme cases when it is a zero value, it continues to remain the same. So in general, a seasoned contract would generally have a non-zero value, which could be positive or negative. And I'll show you an example. If the next statement, if the contract has to be cancelled, this is the amount that needs to be settled between the contracting parties. Now, as in the earlier case, mark to market with a forward contract means revaluing it or carrying it at its current market value. It can be done, but it is done more not so much from a risk management perspective out here, not so much from a margin account balancing perspective, but from the fact of finding out what the value of the contract is. There is very little that else that mark to market will do, because if you can know the academic value, but beyond that, in a forward contract, mark to market does not really hold or work. So let's see. If this is the contract, how much do you think the State Bank of India, SBI? So first of all, before we go to the amount, let's try to answer the first question. Who will pay whom? If this is the contract, if this is the problem, who will pay whom on when the contract has to be closed out? So he wants to close it out in December 22. Who will pay whom? First question is, who will pay whom? Who pays whom? And then I'll come to the amount. Who pays whom? Does SBI pay the customer? Does the customer pay SBI? paying whom? Who will pay whom? Somebody? Does SBI pay the customer? Does the customer pay SBI? SBI pays the customer? No. Or why? Why should SBI pay the customer? That's a 79 minus 78.03. Yes, but that's the amount. That is correct, right? But please realize, let's look at it. Who pays whom? And the second question is, yes, absolutely fine. The customer pays the amount to SBI because the rate is on a decline. Remember that the customer had agreed to buy dollars initially at 79. At a later point, the amount has become, the current market price has become 78.03. So the SBI wants to, so the customer perceives that the customer can buy the dollars in the market at a cheaper rate than what the customer was committed to pay. So if the customer wants to exit, the customer has to pay the amount. Now this brings two additional questions. So the amount that you guys have calculated, so and I can see there is this amount that Trung has calculated, which is basically 79 minus 78.03, which is 0.97 into 250,000, right? When will this amount be paid? Will this amount be paid on December 22 or will this amount be paid on March 31? So the amount that you have computed is correct. There's no problem. The question that I have is, when will this amount be paid? December 22? On 22/12? No, that's a mistake. Because what is happening is, the only way you can enter into this, remember that the 78.03 is also a price for a contract which will start on December 22 and mature on March 31. So basically the payoff happens at March 31. And then you can close off the position today. But if you were to close off the position today, you will actually be paying the present value of that amount, not the entire amount. So this will only be the payment will happen on March 31st. Now, obviously, I have not given you the interest rate out here, but if you had the interest rate, you can then say, okay, I now know the exact amount that I will pay on March 31st. So I can discount it to today, and therefore on December 22nd, you can pay it off. But that will not be this amount. It will be the present value of this amount. Please remember that, right? Now, what this shows you is an interesting thing, that this is essentially two things you can do through this. One is what I have done, which is I've valued the contract. So the value of the contract on December 22 is now what I know explicitly. Or if I want to cancel the contract, this is what I can do. So strictly speaking, you cannot cancel a forward contract. So absolutely strictly speaking, you cannot cancel a forward contract. What you can do is you can enter into an opposite contract where you take the counter position. So in the first case, if you were buying dollars, you then enter into a contract where you will end up selling dollars. So and you match the dollar amount. What happens therefore once you match the dollar amounts? On the maturity date, on the first contract, you are buying a certain amount of dollars. On the second contract, you are selling the same amount of dollars. So what is your net position with respect to dollars? So you will basically kind of cancel out the dollar payments, and then whatever is the difference in the other currency is what the payoff will happen. So what effectively by doing this, you are entering into an opposite, or what is technically referred to as an offset contract. You enter into an offset contract, OFFSET, an offset contract. The offset contract will offset the payment in one of the currencies. So I am going to square off the dollar payment. So I'm buying dollar. I want to buy $250,000, and then I want to sell and on a different contract I want to sell $250,000. So my net dollar position is zero. The only difference in this is there will be a payoff in terms of rupee or on the other currency side. That is what the value of the dollar or value of the contract will be. Okay. So let me kind of quickly discuss a couple of problems with you all, and let's see what you all have to say to this. So these are the four possibilities. The future cash flow outflow in a foreign currency is hedged by a company using a forward contract, and there is no foreign exchange risk. When it is hedged using futures contract, the mark-to-market process does leave the company exposed to some risk. Which of them will they do? Value of the foreign currency falls rapidly during the life of the contract. Foreign currency rises rapidly. Foreign currency first rises, then falls back. First falls, then rises. And for simplicity, I'm assuming that the forward price equals the futures price. Which one? Which one do you think will be better? So which option will you choose? Capital A, B, C, or D? Well, you all already have the answer. So, I mean, since you all have it, the answer is C. Forward is better. So, forward is better when the currency falls rapidly in the rise of the contract, or first falls and then rises. Futures is better when the currency rises or first rises and then falls. Why is that? The rationale is here. Right? If the value of the foreign currency falls rapidly during the life of the contract, the company takes the loss on the hedge. If the forward contract is used, the loss will only be realized at the end. If futures is used, loss is realized every day because of the daily mark to market. And therefore, on a present value basis, the future loss, the entire loss being realized at a later point, discounted to today, is a preferable argument. Similarly, when the foreign currency falls first and rises back, the forward leads to a slightly better outcome. This is because when futures are used, early cash flows are negative and later early cash flows are negative, later cash flows are positive, and the point at which they will be accounted for will actually make a difference. In the other two scenarios, the futures is useful because exactly the opposite rationale of the forward argument that I have out here. Which of this is false about an arbitrage? Arbitrage, so D is the false answer because arbitrage can cause markets to be less efficient. Well, that's false because arbitrage is defined by the existence of riskless profits, and arbitrage you actually helps arbitrage actually helps market become more efficient, because as markets as arbitrage opportunities arise, people spot the arbitrage opportunities, and therefore the first person makes the money, but subsequent people will not make money, and therefore it will become more efficient as you go forward. Consumption commodity arbitrage strategy cannot be used in some cases. Is this true or false? It's a true statement, right? Because again, this is, as we said earlier, this is less than, this is not showing up, but in strictly speaking, this will be less than or equal to this. So it's not equal to, it's less than or equal to, and that's correct. What happens here? 1 year long forward contract, non-dividend paying stock, price is 40, risk rate is 10%, with continuous compounding. What is the forward price and initial value of the forward contract? And subsequently, 6 months later, what will happen? So the forward, what is the initial value of the forward contract? By definition, the initial value of the forward contract has to be 0. Why is this not showing up? Okay, I don't know why this is not showing up. Again, a canvas problem. But what happens is, the first case, the forward price is nothing but the initial value of the forward price is nothing but 40 into, it's continuously compounded, e raised to the power of r is 10%, and t is 1. So 40 into e to the power of rt is what your initial value of the forward contract is going to be. So, sorry, the forward price is going to be. The initial value of the forward contract by definition is going to be 0. 6 months later, what happens? The price is 45. So what is the forward price at that point? The forward price at that point will be 45 into e to the power of rt, whatever that value is. What is the value of the forward contract? The value of the forward contract will be 45. At that point, it is going to be 45 into e to the power of rt. But remember, t is now 6 months and not 1 year. So in that case, it will be 45 into e to the power of 0.1, 10% into half a year. And the original value of the forward contract was 40 to the power of rt, where t was 1 year, and r is 10%. So the difference between the two is essentially what the value of the forward contract is going to be on that day. As I said, it is not showing up on this slide, but in the handout, it has actually been worked out, and you actually have the solution given to you. The same thing. Okay, let me just note this. The same thing is kind of, so the solution. This is the problem, and the solution has actually been written down in full detail in the solution that I provided. So again, without that, will not show much of it. So the solutions are not showing up for some strange reason. The problems are showing up, but the solutions have all been done and written down in full detail in the handouts. So you can kind of look at the solution from the handout per se and look at it and then check it. Okay. And if you have a question, then let me know, because then I will kind of discuss the problems per se with that. Okay. Okay. I'll for the time being, let me skip this, because this I will actually have to correct it, because otherwise you will not figure out anything on this. But let me go to the next one, which is hedging strategies. Okay. So now we've talked about futures, we've talked about forwards. The question that I have now is, what do I do with this? What do I do with this hedging? What do I do? How can I use them? Remember, at the end of the day, I want to reduce risk. I want to have a risk management strategy in place, which means I need to hedge. How do I use these futures for hedging? So hedging per se implies elimination of risk. and obviously if you're doing a price hedge, it is elimination of a price risk. Perfect hedge means, as the name suggests, completely eliminating all the risk. There is no risk left. Now, in general, perfect hedges are not going to be available, and they're very rare using futures contracts. So what we do is we try to hedge as close as possible to the perfect hedge. Ideally, I would like to hedge it perfectly. Ideally, I would like to be able, like anything else, I'd like it to be as perfect as possible. Obviously, it is not always possible. It is not always doable to kind of do it in that manner. And therefore, what we try to do is to kind of hedge it as close as possible to the perfect hedge. So you can have two kinds of hedges, hedge scenarios that you can come up with. You can come up with a long hedge, you can come up with a short hedge. A long hedge is undertaken when the trader wants to buy an asset in the future and wants to lock in a price. A trader will undertake a long hedge, long futures. So how does he do it? When he buys a long futures contract, when he anticipates the need to buy in the future. Now at a later point, when he has to close it out, he shorts the same contract, he sells the same contract on the date when he buys it in the spot market. And then when he buys it in this, he plays out the difference. The benefit from the buy-sell of the forward contract is where the benefit that comes from. So let me show you this. As an example, and obviously there are examples of the short hedge also subsequently. So let's say, May 15th is a random date that I've taken. You can choose any date, doesn't matter. A petroleum product producer has negotiated to buy 1 million barrels of crude oil. The price that will apply in the contract is the market price on September 15th. So the delivery will happen in September. You are entering into the hedge in May, and the delivery will happen therefore after 3 months, after 4 months. I'm sorry. So it's a 4-month contract, and then the market price. Price that will apply in the contract is actually the market price in September, on September 15th. On May 15th, the market price, the spot price was $100 per barrel. As of today, the market is the September crude futures or September crude oil futures. As of today, is priced on the exchange at NYMEX at $105 per barrel. Each barrel of contract is for delivery of 1,000. Each futures contract is for delivery of 1,000 barrels. He wants to buy 1 million barrels, so the company can hedge its exposure by buying 1,000 September futures contracts, by going long on 1,000 September futures contracts, or equivalently, which is the same thing as saying, I'll buy 1,000 September futures contracts. Fine. Now what happens? Now let's see what happens in September. And I do not know what will happen, because price can go up, price can go down. All I know is the futures price of 105 is constant. Beyond that, price can go up, price can go down. So what can happen? And that's what I want to try to look at. So what am I saying? Let's say the first case, the price goes up. So instead of the target price of 105, price has actually gone up to 110. And this is more than the futures contract price. So what happens? The company buys, and then remember, futures contracts predominantly are used for hedging and not for physical delivery. So how will but the person still needs the oil. So the person goes and the company buys the oil in the spot market and therefore pays $110, which is more than the 105 that it had committed to pay. But hold on, it will adjust. Now, given that September is a delivery month for the futures contract, remember at maturity, the futures price and the spot price should be very close to each other, because they should match on maturity. They should be matching perfectly. There should be no difference. Theoretically, there should be no difference between the futures price and the spot price on maturity. Now here the delivery is happening in September. You still have a few days left, and therefore, but what will happen is the prices will readjust to the current market price and be close to that. And then obviously, if the price is expected to go up, the futures price will also be slightly higher. So let's assume that the futures price is 111. So what is happening if the futures price is 111? So what you are now buying, you are now selling the futures contract at 111. So you had actually 100. So you will now buy it at 100. So you will sell the contract at 111. You bought the contract at 105. So by buying and selling the contract, you are making a profit of 6. You bought the oil in the market at 110. So out of which you earned 6 out here. So basically, therefore, your net price of buying the oil becomes so you will actually have a profit of $6, or what will happen is your cost will get locked in at 104. Even though the price has gone up, you managed to buy it at 104, which is even lower than the futures price that you had entered into. What if the other side happens? Let's say the price goes down to 103. Because in as much as I expected the price to go up, the price does not always have to go up. The price can also go down. I wanted to go. I would have been happy if the price goes up, because then I can buy it at a cheaper price. But it is not in my hands to control that. So let's say the company now buys oil in the spot. If it goes down, the company buys oil in the spot at $103. Now, since September is delivery month for the futures contract, the futures price on September 15 should again be very close to the spot price, and therefore, let's say it's kind of so basically, futures delivery month, the futures price on September 15 should be very close to the current spot price. Let's say the current spot price is 103, then this should be 104. So what happens? Price is very close, 104, the same story. You are now buying the oil at 103, but now you lose, because what happens? You are now going to buy the. See, remember, the futures price is less than the spot is less than the futures price. So now you will actually have to buy the futures price at 104. How much is the loss? You have to sell the futures price, futures contract to close it at 104. You had bought it at 105, so you are losing $1 in there, and you are buying the oil at $103. So now with that you add the loss, your effective price becomes 104. And therefore you see you are still better off than the 105 that you set up, and you are locking in your price. Your price does not undergo any fluctuations. So therefore you have managed to kind of hedge under the assumption where you will buy oil, and I have taken both sides, that oil price can go up, oil price can go down. It does not have to be equal to the price that I have kept. The reverse is the short hedge. The short hedge is undertaken when the trader thinks that he would need to sell the asset in the future. When the trader undertakes a short futures contract, which when he anticipates the need to sell in the future, later on the day he goes long on the same contract on the date when he sells in the spot market. So basically, effectively what he's doing is he's using both the spot and the futures market to play the game, to hedge, but he's kind of also using the futures contract to do that. What happens here? Let's take the same example, except now instead of buying, he wants to sell. Everything else is the same. He wants to sell. All of the numbers and all I've kept it the same, but he wants to kind of. I've just changed the equation from wanting to buy to wanting to sell. That's the only difference that has happened. Again, take both the scenarios. Price goes up, price goes down. If the price goes to 110, the oil spot price is greater than the futures price. You will sell, as a company, you will sell the oil in the market at the spot at 110. Now, because September is a delivery month, the spot will very close to the futures will also be very close to the spot because it has to match. And let's say it's 111. So the loss from the futures contract is he's now buying back the contract at 100. He's buying back the contract at 111. He had agreed to sell it at 105. So there is a loss of $6 by closing the short futures contract, because the short futures contract has to be offset by a long futures contract, and that is costing him $6. He had sold the oil in the market at 110. So that was his income, of which now 6 has been paid out because of this contract settlement. So effectively the price again gets locked in at 104. If the reverse happens, the contract is the price of the market price is lower than the contract price. Company will still sell the oil in the market at 103, but because of the September month maturity, the futures contract will be very close to the spot. Let's say 104. So how much is on that day company's gain from futures position is 105 minus 104. Right? So the same thing will happen on the other side. He sells at 103, but because it is very close to 100, it is the same month, it will have to be close to 103, let's say 104. So obviously what happens, he shorted the futures contract at 105. He is going long or squaring of the futures contract at 104. So he makes a profit of $1, and he has already sold at 103. So the income is 103 plus 1, which is 104. Again, if you can see, he has hedged it and he has locked in his cost, irrespective of whether the price went up or the price went down. So I depending on, obviously, whether I'll do a short hedge or a long hedge depends on whether I want to buy in the future or I want to sell in the future. If I want to buy in the future, I will do a long. If I want to sell in the future, I will do a short hedge. There's something called basis, which is basically the spot price of the asset to be hedged minus or less the futures price of the asset, futures price of the contract used. So in simple terms, it is the difference between the spot and the futures price. So if the asset and the underlying asset futures or contract are the same, the basis should always be 0 on expiration of the futures contract. So if the underlying futures contract and the asset on which the underlying futures contract are written are the same, the basis of the futures will be 0 on maturity. You also have something called strengthening and weakening of the basis. Okay. So if the spot increases by more than the futures, the basis increases because the futures increase, but the spot increases faster, and therefore the spot minus the futures becomes larger, and therefore the basis increases. That is what is referred to as strengthening of the basis. If the reverse happens, that the futures increases faster than the spot, the gap narrows, and that is when the basis declines, or what is technically referred to as weakening of the basis. So what happens? If the futures price leads the spot price, you'll end up getting a market which is called as a contango market. If the spot price leads the futures price, you essentially have the market in backwardation. Right? So if the reverse happens, so if the futures price leads the spot price, you are in a contango market. If the spot price leads the futures price, you are in what is called as a backwardation market. So depending on which one is happening, and then again, as I said yesterday, just because the market is in contango or in backwardation at this point in time does not mean the market will continue to remain in backwardation or contango always. It can obviously change, and because for a given asset it is in contango or in backwardation, does not mean for all other assets it will also be in backwardation or contango, as the case may be. These are specific scenarios. These happen for individual cases and obviously get adjusted accordingly. So what is therefore what? So having defined basis, what is basis risk? Basis risk is the uncertainty in the amount of basis when the futures contract is closed out in a hedge. Because finally you'll have to close out the futures contract. If the price changes, which is what it has, there will be a change in the basis, and therefore there's a basis risk that kind of comes into picture. What is the impact of basis on net buying and selling prices? Net buying and net selling price. Look at this. I have two time points, T1 and T2. The spot at time T1 is S1. The spot at time T2 is S2. The futures price at time T1 for maturity capital T is F1, which is corresponding to the current spot S1, and the futures price at time T2 corresponding to spot S2 is F2. I define B1 as the basis at time T1, which is basically F1 minus S1, and B2 as the right. So B2 is the basis at time 2. So basis is nothing but the difference between the spot and the futures. So I have both. I have the spot and the futures at time T1. I have the spot and the futures price at time T2. Therefore, I have the two bases. The basis at time B1 is the basis at time T1. B2 is the basis at time T2. So let's assume that a hedge has been put in place at time T1 and is closed out at time T2. So you entered into the hedge contract at T1. You are closing out the hedge contract at T2. How much will be the effective price that you will get? The price realized or paid plus profit or loss on the hedge. How much did you pay? How much is the price that you will realize or pay? S2. So now, what is the price realized or paid? S2 minus F1 minus F2. But S2 minus F2 is the basis B2. So essentially it is the forward price plus the basis B2 at time T2. Remember, the price realized or paid, how much are you paid? You are going to buy it at S2 and you have entered into the contract at and you're buying it at S2, and now you had bought the contract at F1 and now you are selling it at F2. Sorry, you sold it at F2 and buying it at F2 or whatever. So effectively you get F1 minus F2. But if you rewrite this, that S2 minus F2, so this can be written as S2 minus F2 plus F1, and therefore it becomes F1 plus the basis. F1, which is the forward price at time T1, is known, but B2 is unknown because there is the amount of B2 the B2 value will only be known based on basis S2 value at time T2. You are at time T1, therefore at time T1 your B2 is unknown, and therefore that is essentially your basis risk, the uncertainty that kind of comes in. How does that impact? This is where the impact happens. If you have a short hedge, if the basis strengthens, unexpectedly the hedge's position improves, and if the basis weakens, the hedge's position becomes worse off. For a long hedge, if the basis strengthens unexpectedly, the hedge's position worsens. If the basis narrows or weakens, the hedge's position improves. So that's where this utility that's where this comes in from. There is also this argument of cross hedging using futures contracts. When the two assets in the spot and the futures contract are different. So for example, if you look at this, you may not always get contracts, you may not always get identical contracts and identical underlying to hedge. So this is a classic example that is there. So you say, okay, let's say an airline wants to hedge against future price of airline fuel, jet fuel. But there is no jet fuel futures contract which are available. What can it do? It can kind of take in, let's say, on the other hand, heating futures and contracts are available, and the airline figures out a certain level of correlation between between the actual underlying which I want to hedge and the underlying which I have available to hedge. So in this case, there's a correlation between the jet fuel and the heating oil. So what will happen? This is what will happen. Let S2 start as be the price of the asset underlying the futures contract at time T2, and S2 be the price of the asset in the spot market at time T2. Remember, the asset and the futures contract and the underlying and the asset that you have are not the same. That's why you have S and S2 and S and S star. S2 is the value of the thing at time T2. S2 star is the value at time is the value of the other asset, which is the basis on which the hedge is going to happen. That at time T2. So now by hedging, what do you get? The price that you get is again like we had in the previous one, S2 plus F1 minus F2. And therefore, I can write it down as F1 plus, instead of S2, I bring in an S2 star. So S2 star minus F2, but S2 star is my addition. So that will be mine, that I will take that out. So algebraically to close it, I will get S2 minus S2 star. Where S2 minus S2 star is the part of the basis. If the asset was hedged, and if the asset hedged and the asset underlying the futures were the same, S2 star minus F2, and S2 minus S2 star is the part of the basis due to the difference between the two assets. So obviously now you realize that the hedge, what is happening is that because I cannot hedge using the same asset, because it is not available, I will have these two additional factors coming in, which will then have to be adjusted and hedged in that process. Now, obviously, you also have a challenge in terms of the futures which contract that you use for hedging. If the asset being hedged does not exactly match the underlying asset, you have a problem, because then you need to analyze which is the asset which has the closest and most correlated future, which is most correlated. So I do not want, if the underlying asset is available, life is simple. But if the underlying asset is not available, then I cannot randomly choose an asset. I will act, because that will not be most efficient. I will need to choose that asset which will be most closely correlated. So the correlation needs to be very high in that scenario. Now, typically, when you have the choice of the futures month, you always take the delivery month. A contract is all the contract with a later than spot transaction date delivery month is chosen. So in other words, if I need to have a spot transaction on a given date, the contract that I will choose will be slightly later than the spot transaction date, preferably close to that, but slightly later. So this is because this will allow the long hedge or long hedger to avoid taking delivery of the physical asset, which can otherwise be expensive and inconvenient. And similarly, the short hedger can avoid giving delivery, which can also be inconvenient and expensive. Obviously, the basis risk, as the time increases between the hedge and expiration of the delivery month, increases. So therefore, the general rule of thumb you use to hedge is you choose a delivery month which is as close as possible, but later than the expiration of the hedge. So you basically, so like in the example that I had, which is what I did not explain it there, but this is the rationale of that. Remember my contract, I wanted the spot contract to happen on September 15th. So I was taking September delivery contract. So as long as the hedge contracts expire in the month of September, but after the spot delivery of September 15th, I am safe because the basis does not increase too much. However, if I did not do that, then the basis could kind of significantly increase and I could actually end up having a huge problem in the whole process. Okay. You also have the hedge ratio. So this is basically how good is the hedge. So what is the size of the position taken in the futures contract? divided by what is the size of the exposure. And that will then tell you how much of the amount, how much of the exposure have you actually landed up hedging. If I need to find out how much of the thing I'm hedging, then this is what I need to kind of do. And I want to find out the minimum variance hedge ratio. So I will then kind of link it up to the for change in the spot price during the life of the hedge. Delta F is the change in the futures price during the life of the hedge. Sigma S and sigma F are the standard deviations of delta S and delta F. And as we were talking earlier, rho is the correlation between delta S and delta F. H is the hedge ratio that minimizes the variance of the hedger's position. And the minimum variance hedge ratio, again, it is not shown up out here, the standard canvas problem. You can see is nothing but sigma rho delta S over delta F. Right? Sorry, rho delta S, they are delta, rho times sigma F over sigma S. And if you draw that, this is what happens. So essentially, this is the minimum point, and this is the delta F over delta S position at which you have the minimum thing. You go on either side, the variance of the hedge position increases. So the more or the less of the hedge position gets you higher variability. Higher variability means higher risk. You would want to choose a minimum variance point because that is obviously where the risk variance is the least. I'm not saying variance is zero, but I'm saying variance is the least, and therefore the risk is also the least. And that is what I want to kind of highlight in that process. Now, now I've done this, but once I do this, I also have the other question to answer. How good or how effective is the hedge? How good or how effective is the hedge? So the parameters are that we have a rho, sigma S and sigma F are estimated from historical values of these data of the change in S and change in F values. The assumption that we make is that the historical movement of the futures price is going to get replicated in the future value of the as to how the futures price will move in the upcoming period. So there is some historical basis that we are kind of taking, and we are saying this is how it will move as we go forward. So using this, we can kind of calculate if QF is the size of the futures contract, if NA is the size of the position being hedged, and N is the optimal number, or N is the number of contracts that you need, N can be written down as NA divided by QF. That is something that was here which did not show up, but in your slides you will have it. N is nothing but NA over NA by QF. Now, why do you want to hedge an equity portfolio? Well, one of the reasons, there could be very many reasons. Obviously, risk management is the primary reason, but this is one argument that you can do. Think of you are not in a position to dynamically track your portfolio at some point in time, right? You are not tracking your portfolio in a dynamic manner at some point in time. You are on a holiday. Let's say you are a trader, and then you are on a holiday. So when you are on a holiday, you cannot be tracking your portfolio regularly, right? You don't. I mean, maybe there's no connectivity, whatever. So you need to kind of protect yourself. Now, one way to protect it could have been, okay, before you go on a holiday, you could have sold the entire portfolio down, converted it into cash, put the cash in bank, came back, taken the additional cash, and recreated the portfolio. You could do that, but that might be more expensive. Transaction costs might be there, and the prices may change, and therefore you may actually not be able to take the entire benefit. So that might be a more expensive proposition. That is where hedging might become useful, because you can then do the same transaction without selling and buying it back, and therefore you might be able to save money in the process. So that is where the utility of hedging essentially for an equity portfolio comes in. So to hedge the risk portfolio, the number of how many contracts should you short? Again, this is ridiculous. This is stupid. Anyway, the P is the portfolio value, B is beta, A is the value of the assets of one futures contract. So it's going to be beta times P over A. That is the total, that is the number of contracts that you need to hedge. So let me show you one example, and then you'll get what I'm saying. So let's say the value of the index is 1000, S&P 500 index is 1000. Your portfolio is $5 million. The interest rate, risk-free interest rate is 4%. The dividend yield on the interest is 1% per annum. So this is 4% per annum and 1% per annum, right? The beta of the portfolio is 1.5. Beta of the portfolio is 1.5 means what? It means that if your underlying asset moves up, if the market moves by 1 unit, your portfolio will move by 1.5 units. So it is both good and bad in the sense that if the markets are going up, your portfolio is moving at a rate faster than what the market is moving at. In fact, the portfolio is doing better than the market. But it is bad when the markets are going down, because then if the market goes up by 1 unit, your portfolio goes down by 1.5 units. Because it is moving faster than the market, it is moving down at a faster rate, and that's a bad idea that you can have. So in a downward scenario, in a downward market, you do not want a portfolio with high beta. In an upward market, you obviously want a portfolio with high beta. So a futures contract with 4 months maturity is used to hedge the value of the portfolio for the next 3 months. So I take a 4-month futures contract and I say I will use that to hedge it for the next 3 months. Obviously, I could have taken a 3-month contract, but I cannot take a 2-month contract to hedge for 3 months, because the life of the hedge contract, life of the futures contract that I'm using to hedge should be at least equal to, if not more than, the period over which I am hedging. Because if that is not the case, then the contract will expire early, the hedge contract will expire early, the underlying exposure will still be there, and I will be left with an open exposure, which I don't want. Right? And one futures contract is for delivery of 250 times, $250 times the index. So you want to hedge 5 million. One contract is 250 times the index, so 250 into 1000. That is the size of one contract. So the first thing that you need to do is, how many contracts do you need? So I'll come back to the first slide. How many contracts do you need to buy? Your exposure was 5 million. Your each contract was the value of a contract is 250, and into 1000, 250 times so it says out here $250, 250 times the index. The index is 1000, so it's 250 into 1000, 250,000. Now that is the number of contracts that you would need in a normal scenario, which is 20, right? 5 million divided by 250,000, that makes it 20, right? But now what we have said is that the contract, the portfolio beta is 1.5. Therefore, the portfolio is moving at a rate faster, 1.5 times faster than the market. So to that extent, therefore, I will have to balance that, and then I need to buy more contracts. Otherwise, it will be neither here nor there kind of a story. So using that using that information that beta is great, it is greater than 1. In this case, it's 1.5. So in a normal condition, if I needed 100, if I needed 20 contracts, now I'm going to go and get myself 30 contracts. Okay? So I get 30 contracts. Also, before today, the current price is 1000. The current futures value is 1000. So if I take 4% as the dividend yield, 4% as the interest rate, 1% as the dividend yield, and I calculate that how much should be the expected value of the index in 3 months' time, right? 4 by 12. In 4 months' time. So it's 4 by 12. So how much would I expect it to kind of? How much do I expect it to be kind of the index value at the end of 4 months? So it is like S naught, which is 1000 into e to the power of R minus Q. So R is 4%, Q is 1% income. So R minus Q into TT is 3 months. You solve this, you'll end up getting an approximate number, 1010 point something. It's approximately 1010. Okay. So therefore, the expected price is 1010. Now let's say, but this is what I expect today. The contract is for 3 months. The life of the futures contract is valid for 4 months. I am using it for a 3-month period. So therefore, now let us look at what the spot price is at the end of 3 months. At the end of 3 months, the index has moved down from 1000. It has gone down to 900. So after 3 months of the hedge period, remember 1 month will remain on the contract. So how much is the futures price then? The current spot price, the current spot value into the 1 month period. So into the same story as the previous one, except instead of 1000, you will get it at 900, and instead of 4 by 12, it will be 1 month. It will be 1 by 12. Once you solve that, it works out to be approximately 902. Right? So the gain from the futures position, how much are you gaining from the futures position? Remember, you had shorted the futures position at 1010. You had gone long. Now you are going long on the futures position at 902. So therefore, you are making a profit of 108 per contract. You have, how many contracts did you have? You had 30 contracts, and the value of each contract was 250 times $250 times that. So into 250. So therefore, the benefit from the futures contract is, as you can see, $810,000. Now, but the portfolio has suffered a loss. The index pays a dividend of the 5 million will have suffered a loss. So the index pays a dividend of 1% per year, which is 0.25% in 3 months. So now the index had gone down from 1000 to 900. Therefore, the drop in the index was by 10%. But now you've also earned 0.25%. So the net loss is minus 10% plus 0.25%, which is minus 9.75% in a 3-month period. What is the risk-free rate? Remember, risk-free rate is 1% for 3 months because it's 4% per year. Portfolio has a beta of 1.5. So let me apply the CAPM equation. How much is the expected portfolio return? The risk-free rate plus beta times the difference between the market return and the risk-free return. So I apply the CAPM equation. Now all the numbers. I have my portfolio, I have my risk-free return, which is 1%. Beta is 1.5%. The portfolio return is, the RM here is minus 9.75%. And RF is again 1%. So if you solve it, you see that the return on the portfolio goes down by 15.125%. So the return on the portfolio is down by 15.125%. So therefore, the expected value of the portfolio, including dividends at the end of the period, would be 15.125% less, 5 million, which works out to be 4,243,750. But from the other part, you had also made a profit of 810,000. So therefore, you are actually going to get, the total amount. So your portfolio value today, because of the reduction in the market condition, has come down to 4.243 million. But you also earned $810,000. So when you add the two together, your total net worth today is over 5 million. So you have actually managed to not just hedge the risk, you've actually managed to make a small profit of $53,750 out here on your portfolio of 5 million by hedging. Now, will you always make a profit? Not necessarily, but you will always reduce your losses, because if something else happens, this 810 may not have been that high, or stuff like that. So therefore, you could actually not. It is not always guaranteed that you will make a profit. you will always reduce your losses. That is guaranteed to happen. Also, you can use this to change the sensitivity that you have. So you don't want to hedge 100%, you want to hedge. So remember, the beta is the sensitivity of the portfolio with respect to the market. You want to change the beta, reduce it or increase it. So what should you do if you want the portfolio beta to, in the example that I had, your portfolio beta was 1.5. Now I wanted to bring it down by half. So I wanted to bring it down to 0.75. So now originally at 100% levels, so I needed 30 contracts. Now since it will only become 0.75, I therefore need half of that, which means I need 15 contracts rather than 30 contracts. The rest of it will actually work in the same manner. If I want to increase the beta to 2 instead of 1.5, I would need to take a long position in 10 contracts and not in 15 contracts or 30 contracts that I was having. Right? So if beta is greater than beta star, then the short position in beta minus beta star into P by A. P is the size, P is the total portfolio size, A is the size of one contract, is the number of contracts that you would need. If beta is less than beta star, then you take a long position in the reverse, which is beta star minus beta into P by A. P by A is, again, as I said, P is the total size of the portfolio, A is the number of contracts, and that is what you would need to kind of solve for that in that process. Now, finally, there's a last bit out here, and that kind of ends this session, this part of it, which is rolling the hedge forward. Now, what happens is that I want to, so, I did argue that the expiration date of the hedge is later than the delivery date for all futures contracts. Dates of the futures contract that can be used. Now, the question is, I may not get a hedge long enough for the entire period that I want to hedge. I want to hedge for a period of 5 years. The market does not give me a 5-year hedge. The market only gives me a 3-month or a 6-month hedge. What do I do? Well, then I keep on buying. I buy the first 6-month hedge. At the end of the 6-month hedge, instead of squaring it off, I using that I buy a new contract. So I kind of keep on rolling it over, and I do it till the period I need to kind of cover. So if I need it for so if I have 6-month hedges and I need it for 5 years, which means I do it 10 times. I buy the first 6-month hedge. At the end of the 6-month hedge, I close this one, but I enter into a new contract. So I keep on rolling it over, taking the same position in the futures contract. But the only change that happens is I take a later delivery date. So I just change the delivery date and I take a later delivery date, and therefore it kind of keeps on adding up. And therefore the company that wishes to use a short hedge, so I can have a long hedge or reduce the risk associated with the price to be received for an asset at time point T. How does it work? This is how it works. I started at time 0. Sorry, I started at time T1. I buy a short futures contract. The short futures contract should technically close out at time T2. At time T2, I close out the futures contract at time that I had started, but I enter into a new futures contract at T2, which goes to T3, and similarly T3 to T4, and so on and so forth, till I get to Tn. At Tn, I kind of close out futures contract at n-1, enter into a new futures contract, short a new futures contract, which is the NS contract. At time T, which is the final maturity, I close out the last contract. I do not enter into any further contract. So essentially, I kind of roll it over. Every period, instead of closing it out, I close out the contract, but I parallelly enter into a new contract. So essentially, I'm just simply rolling over the payoff. I'm rolling over the benefit or rolling over the cost till a later point, at which point I actually want it to be relevant and then come in. Now, this is a good strategy, but I'll also let me warn you of one small thing. This strategy on the whole is a strategy which is fine, which is acceptable. However, if the market moves in a certain direction, and if you have not controlled for it, if the leverage in the contract becomes very high, then you can land up with a small problem, And the problem that you will end up with is the leverage position is very, very high. And therefore, you may not have the ability to square off. Right? So you might actually end up having a problem that, while you try to close out, the cost of close out and entering into the next contract may significantly be high, and therefore the cost of the futures of the hedge might actually blow up. So while you may not, but the reverse argument on that is, well, I wanted to do a hedge for a long period. I did not have anything, so therefore, even if the cost goes up, well, I'm still getting a certain amount of hedge, and I would rarely do that. Finally, okay, the final point in this is, before I show you one or two of the problems, and then we'll talk about the assignment. Will you always hedge? Think of it. Should you always hedge? Should you always hedge? What do you think? Should you always hedge? I mean, how you hedge is the second question, and that's not what I want to ask you out here. But should you always hedge? What do you think? Nobody? Should you always hedge? Well, not necessarily. In two conditions, you will not hedge. Right? One condition is when you believe the negative thing will not happen. Yes. No, I'll come back here. I've not answered this question, and this is not the problem. I'm generally asking. One condition is the scenario when I do not believe an adverse event will happen. There is no point of me hedging. Remember, my hedge is to protect myself from an adverse event. If I do not think an adverse event will happen, I will not hedge. There is another scenario also where you will not hedge. And that scenario comes in when even if you expect the price, even if you expect the market to move adverse to you, in other words, even if you expect that there will be a loss, there is a scenario where you probably will not think of hedging. And that's one part. The second part is that's when the price is not fluctuated, and which is why the loss will not be large, so you will not hedge. You are absolutely right on that, Pam. But there is another one part also where you will not hedge, where the cost of hedging is more than the expected loss that you can incur. If the cost of your hedging becomes more than the loss that you can incur, there will be no rationale for you to hedge. So you should always look at how much do you expect to lose. I know you will not have a perfect answer because there is an expectation-based story. But how much do you expect to lose? The second question then you have to look at is how much will it cost you to hedge? So I want to hedge. Sorry. I mean, how much can I expect to lose? Right? And the second thing is, if you have a loss, what is the cost? What is the cost of hedging? In other words, if the cost of buying the protection is more than the expected loss. So think of it. Let's say there is an event, and in the event you can lose. I mean, the maximum loss you can have is $100. But to protect the $100, you can hedge, but it will cost you $500 to hedge. Will you ever hedge? The answer is no. The reason is because the $100 loss may or may not happen. but the hedge cost of $500 will always apply on you. So irrespective of what happens, you are paying, and you don't even have to have $500. It could be even $100. The hedge cost is $100, which is a guaranteed payment, but the risk, the loss may or may not happen, and if and therefore you will. I mean, if the cost of hedging becomes very high, if the cost of hedging becomes higher than the expected loss that you would think you can incur, you will not hedge. Else, you will hedge. Okay. Okay. Quickly on this, some of them. This one, somebody said it's false. Yes, it is false because it is consider the example for use a forward contract to hedge a known cash inflow in a foreign currency. The forward contract will typically lock in the forward exchange rate, which in general is going to be different from the spot exchange rate, and therefore this argument is false. The minimum variance hedge ratio is calculated as 1. The hedge must be perfect. The answer is true, false, because the minimum variance hedge ratio is rho times sigma s over sigma f. When it is 1, rho is 0.5. I mean, if it is 1 when rho is 0.5 and sigma s is equal to 2 times sigma f, then it is. But since rho is less than 1, the hedge obviously is not perfect. For the perfect hedge, rho has to be equal to 1. But for this, when it is 1, this kind of a scenario can happen. This is not just the only scenario, but this is one scenario that can happen, and therefore there is not necessarily a perfect hedge. There is no basis risk if the minimum variance hedge ratio is always if there is no basis risk, the minimum variance hedge ratio is always 1. It is again it's a true statement, because if the hedge ratio is 1, the hedger locks in a price of the forward contract, the forward rate, plus the basis risk B2. Since both the F1, since both of these are known, if it is known, there can be no fluctuations, and therefore this would essentially lead to a scenario where the variance of which is a zero variance, and therefore that has to be the best hedge in the system. Okay. 1 second. I just want to see this is here before I do this. Explanation. The explanation is not there again. Okay. Okay. So the last one, quarterly changes in prices of a commodity. Standard deviation of the quarterly changes in a futures price on a commodity is this. The coefficient of the correlation is given. The two change of the choice is given, and then what is the optimal hedge ratio for a 3-month contract? What do I do? Correlation into the ratio, that is the optimal hedge ratio. This essentially means that as of today, you should be this amount into 100, the 64.2% of the size of the company's exposure in a 3-month hedge. The size of the futures contract, futures position, should be about, in this example, about 65% of the size of the company's exposure, given that you're talking about a 3-month contract out here. Okay. And the last one is again the same, and is a simple the same story that I had. It is standing at 1080, and then the contract for delivery is 250 times the index. The beta is 1.2. So how many what do you need? How many contracts do you need? And if you need to reduce it, how many would you need? So 89. One can go back and use that n to find out from the earlier example that you need 89 contracts, and if you need to reduce it to half, you need to have about half the contract. So that's how the 48 comes in. Okay. Now we will take a break right now, but before I take a break, I want to show you one thing, which is what the assignment is. I will upload the assignment also in your in the files, but I want to kind of show you that. this is the assignment problem that I have created for you all. So I have a condition, I have a scenario that there is a fund manager who's raising money and is exposed to deployed in arbitrage strategies and all of that. The fund will specialize in spread trades. Specific trades are given. The questions are, what are the three scenarios? There are three broad questions. This is what I want you to answer. What are the market risk exposures? How will the market risk be managed? And what are the other exposures that can be there? And how can the same be mitigated? So these are the three broad questions that I have for you. That if you were to think about it, I don't want you to get it. See, the computation, the numerics that you will have will all be. We will not have it here. That is a part of the. You can show me through example, not a problem. But what I want you to do out here is to give me a broad understanding and an explanation of how you will go about it and what will happen in the process. The numerical solutions and all of that, we will treat it as a part of your other end-term examination, where I'll have you to do problems and stuff like that and address those problems. But at this point, I do not want. You, as I said, you have the flexibility to enter into. You have the here you have the flexibility of just explaining as to what you will do, how you will do, and why you will do. If you do not use, if you do not remember a formula, in any case it's open book. It's a take home. It's a group exercise. You can write whatever you want, but I'm not worried about looking at the formula, looking at the thing. At this stage the assignment is more about, can you identify the broad way you will go about doing it, and how did you identify that? That is what I want to see. What I want to see is, right? So I want to see how you will go about doing it, and what kind of approaches you take, what kind of rationale you use, what explanations and things like that. That is what I want to see in this. And these are the three broad questions. It's the background, the back end is very simple, but I have these three broad questions which I want you to answer, which I kind of want you to kind of look at and then tell me what you will do. Okay, and we will hope to have this on the last day. So on Thursday, which is the last class, you guys please work on the groups, and then if there's any other questions over the next 2 or 3 days, feel free to ask me. But I would want to see this hopefully on, hopefully we'll be able to have a small presentation from each one of you, each of the groups, about 5 to 7 minutes each, as I said earlier, on the last day on Thursday. So, please, couple of things, make sure that you're there on the last day, because because if you do not present, then you do not get the grade for this. So I need you to, I need you to kind of make the presentations on the last day, be ready with the presentations on the last day. And we will do that on the last day itself. I will upload this assignment on the files part of it as well, so that you can go back and look at the thing later. I will also email it to the office so that they can send it to all of you per se, through email, or I don't know how they'll do it. But this is the assignment that I want you all to do, and you have the next 4 days to kind of work on it. And then we'll have we'll have the presentations on Thursday, right? So you all should have your PowerPoints or whatever ready by Thursday to kind of present, and then we'll do the presentation in any random order of the groups. Okay. Any questions? Do you have any questions? Okay, if you don't have any questions, then let's take a break. Yeah, I need you to prepare. So you can have it's up to you. You can have a PowerPoint, fam, or you can have a report. I'm okay either way. You can have a report. That is good. Let's do a report, and you can use the report to present. You use a small PowerPoint to present, I don't have a problem. But I would want a small report. I don't want you to write a 100-page report. No more than maybe a 5-6 page report is all that I would want you to kind of submit to kind of hand it on that day. Okay. I will put this up there as well on the files for you all to look at. The same on the last day. The deadline is the last day. So Thursday, at the end of class on Thursday. So the deadline for this is on Thursday, which is 20th, right? Today is 16th, yeah, 17, 18, 19, 20. 20th January, Jan 20, the last day. Okay. Okay, let's take a break. It's what's the time now? It is 3, 4. So it is 10 past 4 for you right now. So let's start back at 4:25 your time. Let's take a 15-minute break. We'll start back around 4:25 your time. Okay. Is it fine? And I'll keep this on the slide at this point. I'll update it at the end of the class for those of you who want to read it. And then I'll come and I'll start with the next topic after the break at 4:25.